Is this the financial crisis of 2008 all over again? That's what we're going to discuss today on this episode of Clearview Finance, of the similarities and the differences, and then I'm going to give you my opinion. So the financial crisis is now in the similarities of where we were back in 2008. Everybody remembers 2008. It's a part in history with everyone's investments, the economy, that people try not to remember. Well, let's talk a little bit about the similarities today. Basically what happened, housing was a major decline that caused a lot of pressure on the banks. Well, today, it's treasuries, but the bond market in general. So there's a lot of similarities to a very big asset causing problems with banks. So that's number one. Number two, there's some regulatory gaps. So again, back in the housing crisis of 2008, right, we let housing get out of control. Banks ended up being extremely levered, and that ended up causing the problem when housing prices fell. Well, today there seem to be major regulatory gaps as we started to realize that with the collapse of SVB Bank, Signature Bank. There was a lot of less regulatory reform on those banks, and quite frankly today it was outright egregious, as nobody really paid much attention to what they were doing at those banks. So those are some very similar contexts of where we are today. The other thing that I would say is these were large assets that nobody thought actually could decline. They make up a very large part of our economy in whole. We think of housing in 2008, we have to think of the treasuries and the bond markets today. So those were some very similar instances that caused major problems in our economy, especially when it started with the banks, and that's why they're a little bit similar. So again, is it quite? That's what we're going to happen. And there was one major event, as we saw Countrywide Bank in 2008 have a failure, and part of the big reason is they were in the subprime mortgage market. Well, when we start to see banks today, what happened? They were investing in long duration bonds now. When interest rates went up, bond values came down. So they weren't measuring their interest rate risk properly. So those were two major events that nobody thought would happen. Who would have thought the housing market would have collapsed? Who would think that the bond markets would actually go down and go down as quickly as they did when interest rates rise? So those were some very similar instances. Now let's talk about some of the differences, and we'll kind of give you some of the good news, right? Housing market was the major problem in 2008. Well, the good news is today, right, is that housing markets had went down. Well, today there's your treasuries. And so a lot of these banks right now holding treasuries. Treasuries are safe investments as long as we hold them to maturity. So again, a much safer asset because there's not as much risk as long as we hold it to maturity. So as long as these banks aren't forced to sell the asset, there's no reason for any issue with lack of liquidity or even a solvency issue. So again, as long as they're not forced to sell, big difference compared to where it was in 2008. Okay, so that's one big thing. The other thing is, back then, the government and the Federal Reserve got involved way too late. They found out way too late, had to react in 2008 after the crisis already started. The good news in where we are today is the government got involved much quicker, had a much quicker reaction to it, and a much quicker solve. So again, a lot quicker government intervention. That's going to be a really big deal as we move forward. And I would say last is we didn't see this rampant leverage that happened in 2008, meaning banks were so over-levered, investment companies were so over-levered. Think of Lehman Brothers. We're not anywhere near that at this point. Again, it doesn't seem that we have any issues as far as that, other than just failure to have proper interest rate duration risk. And again, as I mentioned earlier, as long as we don't have to be forced to sell, I think we're okay. So that's why a lot of people sit and talk, are we anywhere near the same situation we were then? And I don't believe that there is. There's a lot of similarities, of course. There's actually more similarities than there's differences, but I think this time is actually a little different. So keep focused on the asset at hand here. A treasury as opposed to housing market, big difference. The government has been through this before, so it's highly unlikely that they're going to let something like that happen again. So keep that in mind. Instead, this looks more like what happened in the 1980s with the savings and loan crisis, where a lot of these smaller regional banks got highly engaged in lending practices to the oil and gas industry, highly concentrated, and it ended up, when the oil and gas industry got in trouble, they started to fail. But it ended up not being a systemic problem in the entire banking industry, let alone the economy, let alone the markets. So I think that's what we're seeing a little bit more today. So again, let's all relax. I think right now at this point, we're not seeing it to be anything near 2008. And I say yet, we'll have to keep an eye on where they go and how the banks handle everything. And again, as the confidence grows in the banks, less deposits come out. I think the crisis will be averted at this point. So stay tuned for the next Clearview Finance.